I think that they found all of these words, written in these economic textbooks that allowed them, frankly, to justify what a lot of people were doing in a lot of other markets, which is just straight up speculation because the money printer was going burr.
In his All-In podcast, Chamath Palihapitiya continued to explain his difficulty with what is to come with the exchanges in crypto. The first half of 2022 has seen a lot of bloodshed throughout the crypto marketplace, with simply all the top crypto, including Bitcoin and Ether, dropping half of their price since January. Booms and busts are regular as other assets throughout the board have visible decline because of the financial downturn. However, what has been a greater concern within the crypto space has been the downfall of exchanges and seeing what's behind the structure of these investments. We first noticed the fall of Terra Luna. Then we saw Celcius appeared vulnerable. Now, FTX founder and CEO Sam Bankman-Fried has come ahead and stated many exchanges are secretly insolvent. Bankman-Fried, who's ranked 60th in the 2022 Forbes billionaire list with a net worth of $24 billion, is playing the position of a present-day JP Morgan, who legendarily bailed out the unregulated banking system within the Panic of 1907, which later brought about the creation of the Federal Reserve. Bankman-Fried injected capital into BlockFi and Voyager Digital, with reports that he's now buying the former. With all this stated, Chamath believes all of this bailout and broken promises by exchanges will cause a large regulation to the point in which he believes crypto might be the most regulated zone within the marketplace. Many crypto fanatics are dead set against regulation. However, Chamath believes as soon as loss takes place, there might be balance and increase within the marketplace. But before we pay attention to Chamath, if you are not subscribed, make sure you subscribe, as we put out day-by-day content to keep you up to date on the market.
Crazy thing about this chart when you look at it is, and it's pretty obvious, is that we are collectively in one way, shape, or form basically trading up ever since 2018, really, with all the stimulus. Because if you look at, the mean price of Bitcoin of 2018, it was a nothing burger. What we were talking about was, a price that was sort of between a few $1,000s, $2,000, $3,000,
10,000,
and then 3,000. And then all of a sudden, when all of the stimulus money hit the market, look what happened to it. Yep. But I think something unique also happened, which is that people really understood how to run these very complicated off-chain Bitcoin arbs. And I think we should explain what those are, because those are what's behind the Three Arrows Capital. It's behind, I think Sam had this kind of oblique tweet that said, some of these exchanges are actually already insolvent. They're already the walking dead. So the first thing to keep in mind is that, this is a completely unregulated market, right? There are no market makers per se that actually have reporting requirements to any regulatory authority. There aren't any clearing houses. There isn't a way for us to understand systemic risk as it builds in the crypto market. So what happened starting in 2018 and 19 is people realized the following things were true. It's sort of what we talked about last week. You go and do some crazy round, you mark up some phantom equity in a company. That company then issues tokens. You then list the tokens, not on a blockchain per se, obviously, but in a place where trades can happen off-chain. Right, and there's a bunch of exchanges where these things happen off-chain because it's one, company, and then they have a bunch of segregated sub-accounts. And what happens is when these things initially get listed, retail goes crazy, the price goes up, folks basically dump on retail, and you spin that loop as fast as you can, and you can extract an enormous amount of money. Along the way, all these things like DeFi all of a sudden popped out of nowhere. And it's like, hey, you can earn 15, 16, 17, 18%, just deposit the Bitcoin. And so folks would deposit Bitcoin. But then what would happen is like the places where those deposits were held would then need to obviously find places to make that 11, 12, or 13%. And so then they would go off chain to some other random person who was offering to pay them even more than that. And they would try to arb the difference. But it all catches up with you because when something like a Terra goes to zero, all the Bitcoin that was used to basically, run that DeFi process around Terra vanishes. And then all of a sudden you, the lender, are like, hey, can I have my Bitcoin back? And the broker's like, well, actually, I don't have it. I lent it to somebody else. Let me ask that someone else. And they're like, I'm sorry, I don't have it, but I have these Terra coins, because I was running some ARB and now it went to zero. And that's essentially what we're seeing right now. So we have two big problems. And then I think we have a third that's kind of funny. The first big problem is, like, obviously in the absence of any regulatory oversight, this stuff is going to happen. Systemic risks are going to build up. That's what we're facing right now, is an enormous amount of systemic risk, largely around Bitcoin. A bunch of this money, I think, has been essentially just vaporized. And so all these people that try to find their deposits, especially in custodial accounts in off-chain brokers, may be SOL at some point. And I think that's just going to be a huge shit show if that actually happens. Does anybody have recourse to this Three Arrows Capital and all of this other interrelated parties that are now, gone completely bankrupt because of this scam? The answer is absolutely not. So that's the first problem. You have absolutely zero oversight, which means systemic risk has been built up in the system. The second thing is that people don't even understand chain of custody here, which is that you thought that you owned this Bitcoin. It turns out you actually may not actually own them at all. You thought that you were properly lending them out. You actually don't. There is no enforceable contract, it turns out. And so I think that's going to be an entire set of different legal issues that are now going to come to the surface, because people who actually legitimately lent this stuff out, for example, like if you short a stock and you go and borrow stock from any one of us, there are really tight guardrails. If you wanted to go and put a credit derivative swap on against debt, there's a central clearinghouse that makes sure you're not over-levered. You have to go and get audited by a bank to even get the kind of account that allows you to put these derivatives on. None of that was possible in crypto. And then the last thing, which I think is kind of funny, is that we've had to listen to every millennial and Gen Z market observer in crypto tout how this is not like boomers, and they turn out to be the same. I mean, this is the funniest thing of all. It's like, of all of the times you've had to hear how it's so different, it turns out it is entirely the same. Entirely. In fact, worse. I mean, I tend to think at this point, Bitcoin probably has to be regulated like a security, even if it is not, and it's more of a commodity, only because of the volume. Like, again, as I've said, like, look, if you're a market participant trying to trade, very sophisticated, derivatives of any kind, for example, in the credit markets, we have to go and we create these things called ISDAs. They're called ISDAs, and it's basically a kind of an account that allows us to go and, take risk in some of these very esoteric markets. But the underlying principle around that is a common set of parameters, a clearinghouse, the ability to monitor risk. None of those things exist here. And I think that's really what folks have to solve for now. Secondarily is, what were all these kind of like shadow activities? It seemed too good to be true when you would hear, wow, this DeFi protocol will yield you 24%. It never made sense really, but then none of us really questioned it. We have to answer a really important question. Look, the markets have incinerated many trillions of dollars. I just saw, like, for example, there was 1.7 trillion, that was just torched in ETFs alone, just since the beginning of this year, right? We've done that or more in the crypto side. We've done that or more on public equities, right? We're probably going to do that or more in other markets. But every other market is regulated, and there's a full accounting of the P&Ls on the dollars that are won and the dollars that are lost. And here, some folks have just, basically escaped with billions and billions and billions of dollars. And the bag holder is just, a retail investor. So the real question is, are regulators going to actually care to try to do something? Because the level of grift that's happened in this market is extreme. And especially when everybody was telling you, no, this time is different. This market is completely different. It's transparent. It's on chain. You can see and it turns out actually most of it was not on chain. It was off chain. And if you look at this 92% correlation to the equity markets, I suspect in Bitcoin and crypto is probably closer to even 100%, because it really was the furthest out on the risk curve, and it just made the most sense when you thought money was, effectively infinitely going to be available, to just buy the riskiest risk assets. and absolutely zero rules and oversight. The feature that was touted was actually the first one to get thrown away, which was transparency.
Yeah.
When all of this activity was actually happening off chain, this is why you have this systemic risk issue now. When Sam is saying some of these exchanges are actually insolvent, what he's saying is, well, that exchange has one master wallet address. Every time you open an account and transact on such exchange, you're actually just transferring between a database entry inside of that company. And so it may look like it is fine, but it is actually not fine. That's what he's claiming. This is the problem with all of this. So all of this activity, built on these principles of openness and, defensibility, and, you can't inflate it and, devalue it and debase it, turned out to not even matter, because the fundamental principle that would allow us to verify all of that was violated right from the get-go, which was transparency. All of it is happening in the dark. Most of this stuff is happening off chain. And if you think that, it's okay to torch $1 trillion of equities, well, at least there's rules on the equity side. But to torch $2.5 trillion in crypto where there are no rules, it'll be really, it'll be a very telling sign to see if these folks get their act together, and meaning regulators and politicians, and do something.
If you want to look at the complete video, take a look at the hyperlink in the description. What do you think of Shaman's opinions? Do you believe on his opinion on regulation? Leave a comment in case you found value in the content. And hit the like button, because that significantly helps the channel discover similar viewers like you. In case you're not subscribed, ensure to subscribe, as we put out daily content to keep you up to date on the market news and conditions. Thank you for watching, and we'll see you in the next one.